what is the impact? So now the tax on buyer. Okay, so the $2 tax you have put on the buyer. Okay, so what will happen if you put the tax on buyer? So this was your earlier demand curve. Okay, now because you have to shell out $2, your benefit is decreasing by $2. So you see that their benefit has all throughout decreased by $2. So your result will be your demand will decrease by how much? It will decrease by the tax amount. So this is your demand minus the tax. So this is the demand you have. Okay, and what about the supply? Okay, supply will remain the same. So your supply remains the same. So what happens is, okay, this was your equilibrium quantity. Since the demand has come down, the quantity that you will produce will be again lower than the equilibrium quantity. Okay, and since this is a new demand curve, the price that the supplier will get, this will be the price of the supplier. Okay, but the price that the consumer will pay, it will be more than that. It will be the supplier whatever the price he received plus 2. Okay, because that is the tax he is paying, right? And the consumer benefit will be counted. This will be the consumer benefit. Supplier benefit will be this. Okay, and the deadweight loss will be this area, and the tax benefit will be the tax that the government will get is this one, right? So here what will happen is, like, this is the equilibrium. So the government takes this much money from the buyer and it will take this much money from the supplier, right? And the same analogy we can get. Let us see. Okay, we have the same equation over here. Okay, note that again the quantity demanded will be same as equal to the quantity supplied, right? So if you had the quantity demanded is same, so this is the price that the consumer is paying, so which is the price of supplier plus 2, and the supplier is paying is getting this is the price, right? So if I compute, it is 30 minus PS plus 2, it is minus 30 plus 5 PS, right? So bring this here, it will be 30 plus 30 plus 2, it will be equal to 6 PS. Okay, and so this will be equal to how much? 62 by just 1 minute. Sorry, this should be minus PS minus 2. So this will be minus 2. This will be 58 by 6. So the price that the supplier will get is 58 by 6, which is nothing but 9.67. Okay, exactly the same as the last time, and price that the consumer will pay will be supplier plus 2, which will be 11.67. So we will not feel any difference, right? So it tax is imposed on supplier or consumer, it works the same. Okay, the price ultimately each end up receiving or paying is the same. So supplier will still get 9.67, consumer will still pay 11.67. Deadweight loss, surpluses, they remain the same over here also. Then the next item, the quotas and subsidies are not covered in the book, but it gives a sense to, because these are also government intervention. Okay, what happens when there is quota imposed? When there is a quota imposed, it says that, okay, so if this is your supply and this is your demand, okay, so this is the equilibrium quantity that you are producing, government says that no, in this industry there is a quota and this is the only amount of production that can happen. If the quantity equilibrium was 20, they will say that no more than 15 can be produced. Why quota comes? Usually this quota are there in the developing economy. Okay, as an example, India earlier had quota on scooters. So scooters, like one company which was pioneer is Bajaj. So if Bajaj wanted to supply, let's say, 20,000 scooters a month, okay, it was forced to supply only 6,000 scooters a month. Why? Because the government said that you are diverting precious resources like iron, okay, copper, etc. to the scooter, and scooter was considered as luxury in India at that point of time, right? So government said that no, we will impose a quota and you will not be able to produce more than 6,000, right? So when you have a production quota, what will happen is you will produce lower than the equilibrium, and then there will be a loss because of the underproduction, right? So quotas will result in underproduction only if quota is below the equilibrium quantity. Okay, then another item that is there is subsidy. Okay, so if you see the subsidy, Okay, what will be the impact of subsidy? Okay, think about it. The fertilizer cost is, let's say, $200 per metric ton, assuming. Okay, and the farmers, they are getting this at, let's say, $50 per ton. Okay, the amount of 150 per ton is borne by the government, right? So this is a subsidizing, so they are getting $200 worth of good at $50, right? So when people get something at lower price, okay, what happens is they do not understand its value. Okay, so since they do not understand its value, they will over consume. Okay, so they will over consume this. Okay, now this subsidy of $150 is, some of the countries they give directly to consumer, okay, or some of the companies they give directly to producer. Okay, but the effect is same. Okay, now if there is more demand, think about it, this is your demand curve and this is the supply curve. Okay, this was the equilibrium quantity and price. Your equilibrium price was 10, but the government says that, okay, you will be able to buy something at, let's say, 8 rupees. Okay, when 8 rupees is there, this will be the demand. Okay, and demand increases and suppliers will also produce more, because suppliers are not suffering the losses. Whatever is the increase in the price, that is being given to the supplier by the government, right? So what happens is there is an additional supply that comes in the economy, right? And there will be overproduction, overconsumption and overproduction. Okay, because of more supply, because the money is paid to the producer or to the consumer. If there is overproduction, this will be your deadweight loss. So both your quota and your subsidy will result in deadweight loss. Quota because of under